Throughout the years, we've worked with dozens of business owners, and there is one common thread that we notice continuously when it comes to how they take income. When you set up your business, there are different entities or business structures that can be used to create your business. The first one can be a sole proprietor, the next one can be a partnership. Then you have what they call an LLC, an S corporation, and a C corporation. When you look at a sole proprietor and a partnership, those are set up strictly as a business of I am the solo owner or I have another partner that's involved. Then you can go to the level of an LLC to where you can then have multi members of that LLC. And then what happens is you have the ability to file your tax status as a sole proprietor. You can file as a partner. You can file as an S corporation. So you have multiple different options depending on your accounting professional. Then you have the ability to then create just an S corporation. So every time you file, you're always filing as an S corporation. And then there are C corporations, which C corporations are a whole different animal within themselves because taxes are handled way differently with that type of entity. So when you think about being a sole proprietor, a partner, an LLC taxed as a sole proprietor or a partner, or even if you were an S corporation, all of the profits and the income that those businesses make get put onto your personal 1040 tax return. So when you're filing as a sole proprietor, you're filing as a partnership, all of that would get funneled through Schedule C's on your tax return. And then you'll end up seeing that income number based in your total household income on your 1040. And then if you're filing as an S corporation, there's a whole separate tax return called an 1120S, where your income will come from that, where after the profits are displayed once all of expenses, including rents, employees, cost of goods, there is a profit number that then gets transferred over to your personal tax return so you can pay taxes on it based off of your personal income tax rate. And then on the C corporation, well, the C corporation has its own tax bracket to begin with. And then as you take money from a C corporation, then you have to pay personal income tax on those dollars. So one confusing question that a lot of people have is that if I take money from a what they call a pass-through entity, those could be a sole proprietor, a partnership, an S corporation. When you take money from the business accounts, am I getting double taxed? And that's false, because what happens is those dollars are already getting taxed on your personal tax return. And when you're a solo owner, if the money's sitting in your business account or if it's sitting in your personal account, it makes no difference. But the biggest question that you should be asking yourself is, how am I utilizing my business to build up personal wealth over time versus letting all of my money accumulate in my business and then one day having to depend on the sale of my business for retirement? And that's the situation a lot of people are continuously in. And there's so much more that we can dive into this. However, if you are not actively setting up a structure to know what goes into your business for growth of your revenue and profits, or what money is getting allocated and dumped onto your personal balance sheet for wealth building purposes, this might be the time for you to take a closer look and get a better understanding of what you're doing.